The jobs report stunned the market. Just 74,000 new jobs added in December. The rate, though, falling to 6.7%. Decision Economics' Cary Leahey joins us with more. Nice to have you.
Thank you for having me.
Your number was 200,000. What happened?
Well, we were like everybody else. We were blindsided by the report. Looking back with 2020 hindsight, weather had a much bigger impact than I would have predicted. Based on historical trends, probably the big increase in people who weren't able to get to work probably cut payrolls by 30,000 workers. That and probably some unfathomables. I mean, why did certain small categories like messengers and couriers fall 25,000? Doesn't make a lot of sense, but I still say that a stripped clean number was still up only about 150,000, which is well below consensus, is well below the recent trend. So I just rack it up to the fact that no number moves in a tight pattern for 6 straight months, and this is the one month where you'll get a little bit of payback. But I don't think it means a lot economically speaking.
The rate of unemployment, though, fell to 6.7%. What do you make of that? Is that a real number, or is it kind of down for the wrong reasons?
It is down for all the wrong reasons. This is not a sign of strength, but as weakness. As many of our viewers know, the labor force participation rate has fallen sharply in the last 2 or 3 years, and in the month of January it fell. So the reason why you had a big drop in the unemployment rate is fewer people for looking for jobs. Unfortunately, that kind of distortion may be magnified in the next few months. As many of the listeners know, about 1.3 million workers are losing their extended unemployment insurance benefits, and generally those people, based on state experience, particularly in the state of North Carolina last year, they stop looking for jobs. And when you stop looking for a job, the unemployment rate falls, but not for the right reason. So you may see further declines in the unemployment rate, but they may be very misleading.
And further declines. I mean, the Fed has this target of 6.5%. What kind of quandary does it put them in if we get maybe closer and closer into that target, but yet we're not seeing the real jobs picture that they want to see?
That's a problem. The Fed started backing away from that last fall, where the chairman, Bernanke, said, well, we just don't look at one variable, even though that's the one variable they picked. They're realizing the mistake they made where they tied their horse to one barn, so to speak. So they're now going to talk about a variety of numbers, which is going to complicate things, because even if you didn't have as complicated an exit strategy as they want, the fact that the Fed is trying to provide so much information, they can never provide enough information. So eventually I think the Fed is going to come up, unfortunately, with the same kind of story that Greenspan gave us 10 years ago. When they say, Mr. Chairman, what do you look at? He's going to say, we look at everything. And so I think Chairperson Yellen is going to have to say that in the next couple of years. But right now they have to look for something more than the unemployment rate. And they'll probably tell us in due course.
If they'd had this information back when they made the decision to taper now in January, do you think it would have been different?
I think it would have been different. They probably would have waited till the March press conference. Even though Bernanke in the minutes hinted that it wasn't a close call, it might have been a closer call than they'd want to admit in public or in the minutes. So I would think that if you'd had this number in a month ago, they would have said, let's punt till March.
So how does it change their game plan now that they do have it? Do we see maybe a smaller tapering, maybe less than $10 billion that people think we're going to see per meeting?
Well, I think now that they made the cut, they're going to stick with it, but I would doubt that they may cut it again. They may say that this $10 billion cut made in December is good for January, and they'll continue purchases between the next meetings, meaning till the meeting in March, by $75 billion. I would not look for another cut in tapering.
Do you mean that they'll continue at a $10 billion pace per meeting?
No, I think they might not even cut it at all. So I think it's possible. I think the market's going to have to provide itself with the possibility that they wouldn't go from 85 to 75 currently to 65. They may stick at 75. They did say quite clearly they have the option to go both ways. I think once now they're on the plan, I think probably the best guess is they may cut it another 10, but I wouldn't fall off my chair if they keep it at 75.
Interesting. So how does this change your outlook for the U.S. economy? Because we were seeing very aggressive, very optimistic estimates for GDP coming into this number.
It obviously tempers things, but you have to remember that the old expression, 1 month doesn't a new trend imply. And if you get any kind of bounce back to 200,000 or better, the market will throw the January number out as an aberration. But it doesn't really have a direct impact on how you compute GDP, but it would tell you that you want to probably shade things down. And I would say the street consensus, which would include us, has probably gone up at least a half, if not a full percentage point in the last 2 to 4 weeks. So I think the street's probably between 2 and 2.5% won't change that much based on today's number, but anybody that was thinking on Friday maybe ought to push it up towards 3 is going to have a lot of second thoughts. So I think they're going to trim back their optimism.
And just finally, I mean, given how surprising this number was, so many people caught off guard. Were you surprised at how little the market reacted?
Oh, absolutely. I told people that I thought if the number was 150 or around that wouldn't affect the market. But the fact that the 74 didn't give you a snapback in the marketplace surprises me. Once again, you could have one of those days where bad news is good news, and that the market may say, gee, the number's so lousy, the Fed is not going to continue the tapering cuts. That might be positive for liquidity in the stock market, and that may be the thought today. But one last point to make is that if we look back and say that the numbers actually do slow and we see confirming evidence of a better economy but not as good as we might have thought at 829 this morning, it may be that there is an inventory bulge out there. Not huge, but maybe enough that affected the employment data. So if we look back a year from now and say, why was December weak? Well, it was weak because that was the first indication that inventories were a little on the high side in the fourth quarter.
Decision Economics Cary Leahey, thank you so much.
Thank you for having me.
I'm Bobbi Rebell. This is Reuters.